The Japanese yen, once a symbol of stability and economic might, is now facing its steepest decline in decades, sending shockwaves through financial markets and households alike. This isn't just a financial headline, its weakness is rippling through the global economy, affecting everything from the price of imports in Japan to the cost of travel abroad. Everyday life is changing. Japanese consumers are feeling the pinch as imported goods become more expensive, and businesses are struggling to manage rising costs. Tourists, meanwhile, are finding their yen doesn't go as far overseas, making travel more costly and less appealing. Japanese officials are sounding alarms, hinting at drastic intervention to halt the slide. The government and the Bank of Japan are under intense pressure to act, debating whether to step in with bold measures or let market forces play out. Their decisions could shape the country's economic future for years to come. The yen's fall challenges its reputation as a safe haven, a currency investors once flocked to in times of uncertainty. Now, it raises urgent questions about the forces driving this shift. Are global investors losing faith? Or are there deeper structural issues at play? Why is the yen so weak? What can the government do, and how does this tie back to U.S. Federal Reserve decisions? The answers are complex, involving interest rate gaps, global capital flows, and the delicate balance between supporting growth and controlling inflation. We'll break down the reasons behind the yen's decline, the government's options, and what it all means for people and businesses worldwide. From boardrooms in Tokyo to trading floors in New York, the impact is being felt far and wide. By the end, you'll understand the stakes of the yen's roller coaster ride, the global consequences, and what might come next for Japan and the world. Let's dive in. The yen's weakness boils down to one thing: interest rate differences. But to really understand why the yen is struggling, we need to look at the bigger picture of global finance and Japan's unique economic situation. For years, Japan has kept its interest rates at or near zero, hoping to stimulate growth and avoid deflation. Meanwhile, the U.S. Federal Reserve has hiked rates aggressively to fight inflation, making U.S. assets much more appealing to investors. This huge gap in interest rates means investors can earn much higher returns by holding dollars instead of yen. As a result, they sell off yen and buy dollars, which pushes the value of the yen down even further. On top of that, traders take advantage of the carry trade, borrowing cheap yen to invest in higher-yielding currencies around the world. This popular strategy puts even more downward pressure on the yen, as money flows out of Japan in search of better returns. The Bank of Japan's cautious, slow approach to raising rates signals to markets that this interest rate gap isn't going away anytime soon. As long as Japan keeps its rates low, the yen will likely stay weak. Occasionally, the yen rebounds, but these are usually short-lived and driven by fears that the Japanese government might step in to support the currency, rather than by any real improvement in Japan's economic fundamentals. As long as the interest rate gap remains wide, the natural direction for the yen is downward. Investors simply have little incentive to hold on to yen when better returns are available elsewhere. This creates a tense standoff between powerful market forces and Japanese officials who are under pressure to act but are wary of disrupting the economy. The big question now is, will government warnings and statements be enough to stop the yen's slide, or will Japan be forced to take bold action to defend its currency? As the yen slid, Japanese officials ramped up their warnings, a tactic known as jawboning. By threatening intervention, they hope to scare off speculators and slow the yen's fall without spending billions. Finance Minister Katayama's recent statements, "All options are on the table," sent a clear message. Intervention could come at any moment. These warnings have temporarily strengthened the yen, as traders hedge against sudden government action. But jawboning has limits. If threats aren't backed by action, markets may call the bluff. Officials have bought time, but the forces weakening the yen haven't disappeared. The real test: what happens if words stop working? That's when direct intervention becomes the next move. Let's look at what that means and why it's a risky tool. When talk fails, Japan can intervene directly, using its foreign reserves to buy yen and prop up its value. The Ministry of Finance orders it, the Bank of Japan executes it, and billions of dollars can shift the market in minutes. Intervention is like putting a massive thumb on the scale, creating sudden demand for yen. But it's costly. Japan's reserves aren't unlimited, and each intervention depletes this financial cushion. Success depends on surprise and scale. If traders see it coming, they can overwhelm the effort. The goal isn't just to move the yen for a day, but to change market psychology and make betting against the yen risky. Still, if the underlying problem, low rates, remains, intervention is usually just a temporary fix. It's a powerful tool, but not a cure. History proves this point. Japan has a long history of stepping into currency markets when the yen falls too fast. In 2022 and 2024, the government spent over $60 billion to buy yen as it crossed key thresholds. These surprise interventions caused sharp, short-term rebounds, but the yen soon resumed its slide. Authorities care more about the speed of the fall than a specific level, and they act with surprise to catch traders off guard. Past interventions show they can slow the decline, but not reverse a trend driven by fundamentals. Intervention is a brake, not a steering wheel. The yen's fate is tied to deeper forces. Chief among them, U.S. monetary policy. The yen story is inseparable from the U.S. dollar. As the Fed raised rates to fight inflation, the dollar soared and the yen weakened. The Bank of Japan kept rates near zero, making the yen less attractive and fueling capital outflows. Now, with U.S. inflation cooling, the Fed has started cutting rates, signaling the dollar's era of strength may be ending. As U.S. rates fall, the gap with Japan narrows, giving the yen a much-needed tailwind. Many strategists believe the dollar has peaked and is entering a downtrend. This global shift could do more for the yen than any intervention. The real game changer for the yen is what happens in Washington, not Tokyo. The seesaw is tilting. The world is watching. The yen's weakness isn't just against the dollar, it's losing ground to the euro, pound, and Australian dollar too. Japan's ultra-low rates make its currency cheap across the board, attracting foreign buyers and making imports costly for Japanese consumers. For Japanese tourists, trips abroad are pricier. For companies, importing goods is more expensive. Meanwhile, foreign investors find Japanese assets a bargain, fueling capital outflows. Even with recent small gains, the yen remains fundamentally weak. Its underperformance is rooted in Japan's outlier monetary policy. Until that changes, the yen will struggle globally. The problem is homegrown. Experts across the financial world are closely watching the yen, and while intervention threats from Japanese authorities may temporarily slow the currency's decline, most agree that the underlying issue is Japan's slow and cautious approach to raising interest rates. This fundamental policy difference is what's really driving the yen's weakness, and it's a challenge that can't be solved overnight. Most analysts expect the yen to remain highly volatile in the coming months. Unless the Bank of Japan signals a significant shift in its monetary policy, any rebounds in the yen's value are likely to be modest and short-lived. The market is on edge, reacting to every hint of change from central bankers. Some experts like Matt Simpson point out that intervention by Japanese authorities is most likely to occur during periods of thin holiday trading, when market liquidity is low and sudden moves can have an outsized impact. However, such intervention is only expected if the yen plunges past key psychological or technical levels, making timing crucial. Others, such as Charuchanana, believe the yen's days of a one-way slide may be ending. Instead, they see the currency entering a new phase, one marked by choppier, range-bound trading, where sharp ups and downs become the norm rather than a steady decline. The biggest risk on the horizon? If the U.S. economy continues to outperform expectations, and the Federal Reserve keeps interest rates elevated for longer, the yen could face even more downward pressure. Strong US data and persistent rate differentials would make it harder for the yen to recover. Looking further ahead, many strategists remain optimistic about the yen's prospects. As the Federal Reserve eventually begins to cut rates, the dollar's advantage is expected to diminish, opening the door for the yen to regain strength. Patience, they say, will be key for long-term investors. Ultimately, the pace and direction of policy changes at the world's top central banks will determine the yen's fate. For now, uncertainty dominates the outlook, and every move by policymakers is being watched closely. The next decisions could shape the currency landscape for months to come. The yen's swings hit home for millions. For Japanese families, a weak yen means higher prices for imported essentials, energy, food, and more. Exporters like Toyota benefit, earning more yen for every dollar abroad, boosting profits and jobs. Tourists flock to Japan, finding bargains as their currencies stretch further. For foreign buyers, Japanese goods get cheaper. For investors, yen weakness can erode returns when profits are converted back. The yen's journey shows how global finance shapes daily life, from Osaka's grocery bills to Wall Street's portfolios. Central bank decisions in Washington and Tokyo ripple worldwide. The balance between supporting consumers and exporters is delicate. The outcome will shape Japan's future and its place in the world. The story isn't over.